Good morning, everyone. Happy Tuesday. Welcome to today's episode of Morning Wealth. Three things that you can look to here. New high on the Nasdaq and S&P 500 is positive for the year. Stan Duncan-Miller, the legendary investor's positioning, and rally in European bank bonds. US stocks rose on Monday on growing optimism over the pace of the economic recovery, pushing the Nasdaq Composite to its first record close in nearly 4 months. The S&P 500 is also positive for the year. S&P 500 is now climbed more than 40% from the low that we saw in March. Friday's surprising upbeat jobs report continued to stoke investors' demand for stocks. Shares of airlines, retailers, cruise liners and other companies tied to the reopening of the economy led the market higher. Energy stocks also got a boost after OPEC struck a deal over the weekend to extend the production cuts through July. The US dollar in the meantime fell for an 8th straight day, down to a level before the coronavirus crisis sparked a big rush to haven assets. Treasuries edged higher. The 10-year yields were down by about 2 basis points to 0.88. Oil dipped as Saudi Arabia dashed hopes of more cuts at gold advance, and Asian equity futures are pointing to the green. Grim news from World Bank. The global economy will contract the most since World War II this year, and emerging nations' output will shrink for the first time in at least 6 decades due to the pandemic, is what they observed. The US is also in recession. The record-long expansion ended in February according to the academic panel that judges America's business cycles. So the National Bureau of Economic Research cited the unprecedented magnitude of the decline in employment and production, while also noting that the downturn could be briefer than earlier contractions. Stan Duncan-Miller admitted that he was far too cautious in the current market rally. Last month, Duncan-Miller said that the risk-reward calculation for equities was the worst he has seen, and government stimulus programs wouldn't be enough to overcome the real-world economic problems. So a lot of people have been caught off guard from this rally, and even legendary investors were also far too cautious. Moving on to equities, some good confidence cheer in the M&A market. So even if the AstraZeneca and Gilead deal is seen unlikely, the mere prospect is helping stir confidence that M&A can rebound. So with more than 15 billion of deals mutually terminated because of the virus impact, advisors are now saying that talks are resuming. Occidental is considering reducing its stake in oil and natural gas fields in Oman. Interesting observation from Airbnb CEO. He says that the domestic bookings have increased in South Korea, New Zealand and the US, and even other countries that have slowly reopened, as more people are looking for vacations closer to home. In news from RBC on Amazon's target price, they have raised it to a street high of 3,300 from 2,700. The firm pointed to an annual survey of online shopping. The results clearly support the idea that online retail is a structural winner from the COVID crisis, and said Amazon is likely the best global play. On the fixed income side, European bank bonds have rallied over the past few weeks, escaping crisis territory thanks to the easing of coronavirus lockdowns and the proposed launch of European Union-wide recovery fund. Yields on the riskiest type of junior bank debt have fallen back significantly from the peak level that we saw, which was at the worst point of the coronavirus-inspired sell-off. Many investors are remaining cautious though. They are keeping a significant chunk of their assets in cash. Money market assets remain at financial crisis high at 5 trillion is what Deutsche Bank said in a research note. On the FX side, US dollar traded lower against most of the major currencies on Monday, with New Zealand dollar and Australian dollars leading the gains. Dollar yen also was down, completely shrugged off the market's appetite for risk, which continued to push the US stocks higher. After pulling back on Friday, Euro extended its gains despite weak data. German industrial production dropped more than expected in April, with activity contracting by about 17.9%. This was not only a back-to-back decline, but also the worst dip ever. That is your market update. Stay safe and healthy, everyone, and speak soon.